Today I'd like to discuss the 6 stepping stones that explain why Canada's economy will grow by only about 2% this year versus full capacity growth of 4%. The 6 factors, they're closely interrelated, and then they reverse back on each other. Let's start with inflation. The inflation rate's about where the Bank of Canada would like it to be, with the core slightly less than 2%. And this helps to grease the wheels of industry, and it helps with consumer spending. Other prices are holding up pretty well also. For example, housing prices are either steady or slightly increasing. Where there are declines, it's in some things like gasoline, and that helps with consumer spending. Also, the low inflation rate helps the Bank of Canada with its interest rate policy, where interest rates are near a record bottom. And again, that helps consumer spending, and it helps residential construction and non-residential construction. As for the consumer spending side, don't be in any doubt that the bank wants you to borrow money. That's if you're a responsible borrower, and you know who you are. The bank doesn't want irresponsible borrowers to go in over their heads, but they do want responsible borrowers to spend. Now we come to some of the negative factors, and most of these are on the international scene. In foreign trade, Canada is used to racking up a large merchandise trade surplus. At least that was before the recession. Since the recession, the merchandise trade balance has hovered near 0, and that takes away from GDP. And the reason we've had problems on this front is because of the slow world growth. The U.S. is still struggling with its labor market. Housing's starting to come back a bit south of the border. But Europe's got debt problems, and the export-oriented Chinese economy is being held back by problems in the U.S. and Europe. And so that affects commodity prices. And the fact that commodity prices have fallen from their peak, they're still relatively elevated, but that's likely to have some impact on mega project investment in Canada. And then there's the currency value. The Canadian dollar has moved with oil over the last couple of years. When the price of oil came down, the value of the Canadian dollar dropped. But there's another factor that's come into play, and that's large capital inflows into Canada. And that brings us to the final of the 6 factors, which is government spending. Usually in a recovery, government spending works in tandem with monetary policy to stimulate the economy. This time around, however, governments have cut back on their spending. But there's a real positive to report here. Because of the capital inflows into this country, and foreigners want to park their money here, this is a tangible result of the reputation that Canada gained in the recession as being financially conservative and sound. Capital has been flowing in from foreigners, and that's caused the 10-year bond yield to fall to a record low below 1.6%. Compare that with the 7% rate that countries like Greece and Ireland and Portugal and Spain faced and drove them to seek bailout funds. And the fact that the long-term bond yield is so low is going to help our governments pay off their debt faster and reduce their deficits. And that's very positive over the longer term. So in the short term, growth, yes, it's disappointing. Over the longer term, conditions are definitely moving towards improvement.